Hello, everyone. Welcome back to another episode of In the Money, where we break down trading strategies and share actionable ideas for all traders. My name is Andrew McGowan, part of our trading strategy desk here at Fidelity. Many of you may recognize me from the In the Money follow-up sessions that we run on Fridays with the strategy desk. And I'm very excited to be joining you all for the main broadcast this week. With me today, as always, is Tony Zhang, Chief Strategy Officer and co-founder at OptionsPlay. Tony, it's been an interesting week since last Thursday. Glad to have you back on. How have you been?
I've been well. I hope everyone has had a happy and safe holiday. It's been an exciting couple of weeks in the markets and going into year end, there's a lot to look at. So really excited to chat with you about those things today.
Yeah, couldn't agree more. Today, that being said, is Thursday, December 5th. And as I mentioned, we have seen some interesting developments in the markets after a few days of consolidation during last week's holiday week. I know many traders and investors are doing their best to manage risk through this dynamic market environment. So, with that being said, Tony, what are your current macroeconomic views and what developments are you currently watching?
Yeah, thank you so much. Over the last couple of weeks, we haven't really had much on the earnings or economics front for the most part, but really, I think what we've navigated through from a volatility perspective were some of the rhetoric that came out of the incoming administration's views for tariffs and what they expect to slap onto other countries, specifically Mexico, Canada, and abroad. And, there was a lot of volatility around that. However, what's interesting is how markets have rebounded from that volatility. You have the S&P 500 now printing new all-time highs. We broke out above that major $6,000 psychological level here to the upside, printing new all-time highs. And more importantly, you have the NASDAQ 100, which actually recently, just in the last couple of days, also printed new all-time highs, confirming kind of the S&P all-time highs, breaking above that 505, 515 major resistance level on the QQQ. And those are important levels for the equity markets to get past above and to continue the market rally that we've seen since the November 6th election. Our playbook here very much has been that we will likely see a rally going into the year end. And then when you look at kind of equity markets so far confirming those views, and in conjunction with that, you have the VIX falling back to 6-month lows, around that 13% level here. You have the 10-year yield pulling back to around that 4.2% level after spiking up to that 4.5 level on the concerns that tariffs will likely respark inflation. So far, some of those concerns have eased, and that's provided kind of the support that equities needed to continue to rally. At the moment, you have the Fed with a near 80% probability of another rate cut here in December. With a lot of things are kind of aligning to supporting kind of the equity markets continuing this rally into the end of the year. I think really the biggest concern or the biggest risk that I see with the overall market here right now is actually the job numbers that come out tomorrow morning. We had fairly poor numbers in August and September, and that's really what caused the Fed to move that with that first 50 basis point cut here in September. But so far, the data seemingly since then have improved. We had Chairman Powell come out earlier this week and discuss the fact that he believes that the economy was actually stronger than it was back in September, and that gives him more room to decide, the pace at which the cut rates here for December and into next year. But we did see that poor number in October that was largely due to the hurricane and Boeing strikes. So we'll see tomorrow as to whether or not the trend that got started here in August was really more of a fluke or a continuation. Because if we do see some weakness here in the job numbers tomorrow, that does change the calculus here in terms of how strong the US economy is and how much room the Fed has in order to cut rates here. So that's really kind of the big thing that I'm paying attention to here right now. Outside of that, just from a tactical perspective, as you reach kind of these new all-time highs, you do have equity markets reaching kind of more overbought levels. This is kind of a time from a timing perspective, not the best time to add new positions in the market. So I do think that if you are going to take long positions as equity markets reach all-time highs, you definitely want to be more cautious in terms of quality, using quality stocks in this particular case, and also thinking about making sure that you reduce your overall risk to the downside as you enter positions at these specific levels.
Absolutely. I appreciate the insights, Tony. As we mentioned, I think we've been looking at very similar things lately. Something you mentioned, the S&P and NASDAQ for that matter, both getting to new all-time highs here recently. The S&P getting very close to that psychological level of 6,100 here this morning. Coincidentally enough, last time we were presenting together, we spent time discussing the divergence between the S&P making new highs where the NASDAQ had not. And we have finally started to see the NASDAQ catch up in that regard. As you mentioned, though, trading at all-time highs can sometimes be tricky. So it is important to have a plan in mind at all points in time to make sure that we are nimble if these dynamics do change. So what's the first trade idea, and how can we think prudently about the risk and reward opportunities for it?
I want to take a look at is Dexcom, which is probably not on most investors' radar. They are a leader in what are called continuous glucose monitoring devices. This is a device for patients who have diabetes and to be able to monitor their glucose and potentially even deliver insulin. And this is really kind of a company that lives in a pretty niche space, but they've continued to benefit from innovation and increasing global adoption of their medical devices, and they've recently have established some major partnerships with Apple to be able to use Apple Watches to display the outputs of these devices, Aura rings, something that's incredibly popular here as well from kind of a more health conscious generation. So despite the fact that they face some challenges this year, I do think it's time to revisit Dexcom as an investment for investors who are thinking about some types of stocks like this, which have a large economic moat for a long-term investment. So if you take a look at a chart here of Dexcom, what you see here is a stock that has largely struggled here for the past year or so, and recently a gap lower on some disappointing sales. But what we see here is that since that gap lower, Dexcom has slowly bottomed out, and it's starting to break out above some resistance levels and starting to signal that investors are seeing some renewed confidence here in this particular stock, and it's potentially setting up for a rally back up to that 110 level, which would close the gap that it had back here from a few months ago. Especially when you see that the breakout here above that $75 resistance level is coupled with outperforming the overall market, and positive momentum is really what gives me more confidence that this stock has bottomed out and is potentially on is set for a rally here to close that gap. But also, if you take a look at the fundamentals, this is a stock that, you know, on the surface is fairly expensive. It's trading at 38 times forward earnings. However, this is really where you have to dig into the growth metrics again. You know, we're expecting 23% EPS growth, 17%, 14% revenue growth. Net margins are significantly higher than their peers. So the fact that it trades at a relatively high valuation, I think, is justified, especially as it continues to kind of start turning around its business with these major partnerships. I think the upside potential here is still to close that gap back into that 110 level here to the upside. So I think it's positioned well here for long-term growth. We're continuing to see kind of reimbursement coverage for these types of devices continue to expand, and that's going to provide you know, an opportunity to get these devices into more consumers' hands. So the trade structure that I want to use here for Dexcom is really, number one, taking advantage of the implied volatility of the stock right now, but also to execute on what is more of a longer term investment strategy rather than a short-term speculative strategy by going out to the January expiration and selling an $80 put option. Earlier today, you can collect about $4.50 for that short put. And what that basically does is it collects about $4.50 on this roughly $80 stock per, you know, which comes out to be a little over 6% of the stock's value that you're going to collect in about a month's time. However, what that gives you is the obligation to purchase 100 shares of the stock if the stock is below that strike price of $80 at that January expiration. But because you're collecting $4.50, that's going to factor into the price that you effectively own the stock at, which bring that net price around $75.50. Now, remember, the breakout level that we saw here is around that $75 level. level. So what this would allow me to do is potentially acquire these shares at that breakout level, giving me a risk to reward ratio that's quite attractive here to me, because if I end up owning these stocks at 75 and the stock kind of continue, if the stock were to drop back into that trading range, I would get out at a relatively small loss for the trade, versus if the stock does end up rallying up to that 110 level after acquiring the shares, my upside potential is quite significant compared to what I would have to risk to the downside. And that's why I really like this particular trade structure for investors who are potentially looking to add the stock to the long term. And if the stock just continues to rally from where we are here, we're collecting roughly 6% of the stock's value in just a little over 30 days, which annualizes out to a really nice return on the cash that I have to set aside to potentially acquire these shares. So this is really the type of trade that I like to use to acquire shares when the stock has recently just broken out above a resistance level, and I think can potentially take off.
Absolutely. As you mentioned, this name has traded in quite a volatile range over the last few years. So, with the move that we've seen recently in July being the most glaring part on that chart lately. So, since then, as you mentioned, it has reclaimed some of its major moving averages, has seen momentum improve on top of the important fundamental narratives as you have mentioned. So, that being said, now that we are back within that gap from the move in July, it is very important to see how traders react to these levels, as you mentioned. So, it's vital to think about what scenarios benefit this type of strategy that you outline. As you mentioned, it may benefit from bullishness, may also benefit from neutrality and mean reversion, and creates a scenario like Tony outlined where we could be purchasers of those shares at that strike price. The one thing, of course, though, as he mentioned, that we do not want is downside. So having a risk management plan in mind is a very necessary component of this trade that you have outlined. So it is time that we review a trade idea from the last episode or a few episodes ago. These lookbacks have been very helpful for newer options traders because it allows them to see how the risk and reward opportunities have played out in the real world. So with that said, which trade are we looking back on today, Tony?
Yeah, I want to take a look at a trade that I structured a few weeks ago, a bullish trade that I put out here on Meta. At the time, we were selling the December 27th 575, 550 put vertical here. This was really based on the fact that Meta was pulling back to a valuation that looked quite attractive, and the outlook with regards to kind of their quote unquote rebrand to Meta and focusing on kind of the augmented reality space, something that Apple's been working on for quite some time. But it seems like Meta is actually a leader in this particular space, and that's why we took that bullish thesis on Meta, and we sold that credit spread at the time for about $9.80. Now that's now trading at about $2, so meaning we've made the vast majority of the maximum gain potential of that credit spread that we sold. So I think that now is the time, now that Meta's rallied up to about $610, a little over 610, is that actually roll this credit spread to a higher up and out to a new strike price, and basically recenter it to the January 610 580 credit spread. So it's the exact same trade structure. We're just moving it out to the January expiration, and we're moving the strike prices higher. The one thing I do want to mention is that the original credit spread that we sold was a $25 wide credit spread. We are now, because the stock has moved higher here, expanding it out to a $30 wide credit spread. So the 610 580 credit spread earlier today, we can collect another about $10.55, and that's going to give us more upside exposure here to Meta as it continues to improve, both on from a valuation perspective and from a technical perspective. I think that this still has plenty of upside left, which is why we're rolling this credit spread up to a higher strike. Overall, you're still taking on roughly, in this particular case, a little under $2,000 worth of risk per contract here with the new credit spread that we're selling. But this gives me, again, a same neutral to bullish exposure here to Meta going out to that January expiration.
Excellent. That look back really does demonstrate the power of active management and why it's important to have a clear outlook on price, time, and volatility throughout the life of the trade. Oftentimes, traders think for credit style strategies that we have to wait for expiration so we can hopefully keep the entirety of the premium that we collected. But in the time since that trade on Meta was placed, it has continued to find price appreciation, and that has allowed us to reap the benefits of this trade so far and continue to hold that outlook if we still have that into a new trade. That being said, that does bring us to a close for today. I want to thank all of our viewers for tuning in. Don't forget to tune in tomorrow for the Trading Strategy Desk's follow-up session hosted by myself Fridays at 1:30 p.m. Eastern Standard Time. You can sign up for that class by going to fidelity.com/in-the-money-follow-up. We also offer a Fidelity Active Investor newsletter where we strive to provide meaningful and timely trading insights right to your inbox by going to fidelity.com/active investor weekly. We're looking forward to seeing you all next week. Until then, take care, everyone.